Let's get right to it. Gold is no longer just a side bet. It's become the centerpiece of global financial discussions, capturing the attention of investors, analysts, and everyday savers alike. In January 2026, gold is dominating headlines, breaking records, and leading the financial conversation. It's not just a blip. This is a sustained surge that's rewriting the rules of the market. Last month, gold hit a new all-time high, capping its strongest year since 1979. The momentum is undeniable, and the world is taking notice. In 2025 alone, gold rallied 64%, and since early 2023, it's up nearly 140%. These are numbers that have stunned even the most seasoned market watchers. This isn't a slow climb, it's a rocket launch. The pace and scale of this rally are unlike anything we've seen in decades. When an asset moves this fast, you have to ask, what's driving it? Is it fear, opportunity, or something deeper in the global economy? This isn't just for Wall Street, it affects anyone with savings or retirement dreams. Gold's surge is reshaping how people think about protecting their wealth. Gold futures are trading above $4,500 an ounce, and the $5,000 mark is now a real target. The stakes have never been higher, and the world is watching every tick. Today, we'll break down the forces behind this rally, why institutions are loading up, and what it means for your money. Whether you're a seasoned investor or just starting out, this story matters to you. Is this a bubble or a new financial reality? The debate is fierce, and opinions are split. By the end, you'll understand gold's place in today's world and what you should do about it. We'll give you the insights you need to make informed decisions in this new era. Let's dive in and explore the forces shaping the future of gold. Why is gold suddenly the hottest asset on everyone's radar? In recent months, gold has captured headlines and investor attention like never before, with prices reaching new highs and demand surging across the globe. It's a perfect storm, fueled by a weakening US dollar, rock-bottom interest rates, and a world grappling with uncertainty and instability. These forces are converging, making gold shine brighter than ever. Let's start with interest rates. When rates are low, the old argument against gold, no yield, falls apart. Suddenly, the opportunity cost of holding gold disappears, making it a much more attractive option for investors seeking safety. With savings accounts and bonds barely keeping up with inflation, traditional safe havens just aren't cutting it. Gold's reputation as a reliable store of value grows stronger, especially as people worry about their purchasing power eroding over time. Globally, uncertainty is everywhere. Trade disputes, military tensions, and political instability are making investors nervous. Every new headline seems to add fuel to the fire, pushing more people toward gold. In times of fear, people flock to safety, and gold is the ultimate safe haven. It's a tangible asset you can hold, and it's trusted in every corner of the world. Gold isn't tied to any government or corporation, making it the world's emergency fund. When trust in institutions falters, gold's independence becomes its greatest strength. A weaker dollar makes gold cheaper for foreign buyers, boosting global demand. As currencies fluctuate, gold remains a universal standard of value. Low rates and geopolitical fears create a powerful feedback loop, driving prices higher and attracting even more attention from investors worldwide. As gold rises, more investors jump in, fueling the rally further. The momentum builds as confidence in gold's future continues to grow. This engine shows no signs of stopping. The combination of economic, political, and financial pressures keeps pushing gold to new heights. Understanding these drivers is key to seeing why $5,000 gold is now on the table, and why the world is watching gold's next move with such anticipation. The US dollar's relationship with gold is crucial. For decades, the dollar's reserve status kept it strong, but cracks are showing. Countries are moving away from the dollar. De-dollarization is real. When the dollar weakens, gold becomes cheaper for foreign investors, boosting demand. A shaky dollar also erodes confidence, pushing institutions and central banks toward gold. Gold is no one's liability. It's a neutral, time-tested store of wealth. As trust in the dollar fades, gold's appeal grows. The inverse relationship between the dollar and gold is one of finance's most reliable trends. The global shift away from dollar dominance is a powerful tailwind for gold. This isn't a short-term trade, it's a long-term transformation. The biggest buyers in the gold market aren't individuals, they're central banks. These institutions are buying gold at historic rates, signaling a lack of faith in paper money. Emerging markets like China, India, and Turkey are leading the charge, diversifying away from the US dollar. In 2025, central bank gold purchases neared 950 metric tons, a sustained strategic trend. Central banks are long-term holders, creating a strong price floor. Their buying, combined with investor demand, is squeezing supply. Global gold demand hit its highest level since 2011. When demand outpaces supply, prices rise. The central bank gold rush is a major force pushing gold toward $5,000. When the world feels unstable, gold becomes the go-to safe haven. Recent events, tensions in the South China Sea, European instability, Middle East conflicts, fuel uncertainty. High-profile incidents, like the U.S. capture of Venezuela's president, shake global confidence. In these moments, investors move from risky assets to gold. Gold's value isn't tied to any government or company, it's simply itself. During crises, demand for physical gold surges. Gold's main role is wealth preservation, not speculation. As long as global risks remain high, gold's safe haven demand will stay strong. This persistent anxiety is a powerful tailwind for higher prices. 10. There's a quiet crisis. Government debt is exploding, especially in advanced economies. Debt in these countries is projected to hit 110% of GDP in 2026, and it's still rising. Governments have few options: raise taxes, cut spending, or print more money. Printing money devalues currency, eroding your savings purchasing power. Gold, by contrast, can't be printed or devalued by politicians. It's a true store of value, limited by nature. As governments inflate away their debts, they're making the case for gold stronger than ever. By undermining their own currencies, they're pushing you toward real assets like gold. So, what's next? Top analysts at major banks see $5,000 gold as a real possibility for 2026. UBS and HSBC have both raised their forecasts, citing dollar weakness, low rates, and geopolitical risks. When conservative institutions make bold calls, it signals a shift in mainstream thinking. These forecasts aren't guarantees, but they reflect strong market sentiment. Even bullish analysts warn the path won't be smooth. Volatility is expected. Still, the consensus is clear. The bull case for gold is built on solid ground. The road to $5,000 may be bumpy, but it's now a credible scenario. So, what does all this mean for you as an investor? It's easy to get caught up in headlines about gold prices soaring or falling, but the real question is how gold fits into your unique financial picture. Should you go all in on gold? Absolutely not. Putting all your money into a single asset, even one as storied as gold, is risky and can leave you vulnerable to big swings in value. Diversification is key. Never bet everything on one asset. A well-balanced portfolio spreads risk across different types of investments, helping you weather market ups and downs. But in today's uncertain economic environment, there's a strong case for including a small allocation to gold, typically around 5 to 10% of your portfolio. This can add a layer of protection against inflation and market shocks. Think of gold as insurance for your investments. You hope you never need it to save the day, but if things go wrong in the markets, you'll be glad it's there as a safety net. You can buy physical gold, like coins or bars, or invest through gold ETFs for convenience and liquidity. Each option has its pros and cons, so choose what fits your comfort and goals. Before you invest in gold, make sure your financial basics are covered, like having an emergency fund, paying off high-interest debt, and following a solid financial plan. Gold should be a supplement, not a substitute, for these essentials. If you're on stable financial ground, adding a modest amount of gold can be a smart, prudent move to help balance your portfolio and manage risk. Remember, investing in gold isn't about getting rich quick. It's about protecting your wealth and building financial security for the long term, no matter what the markets do. The case for gold in 2026 is strong. Weak dollar, low rates, central bank buying, and global tension. But every opportunity comes with risks. A sudden dollar rebound or aggressive rate hikes could slow gold's rally. De-escalation of global conflicts could also reduce gold's appeal. The path to $5,000 won't be smooth. Expect volatility and corrections. Don't chase the price. Build a resilient, diversified portfolio. Gold's potential is real, but it's about wealth preservation, not speculation. Understand both the opportunities and risks and make informed decisions. You're in control. Be smart, be strong, and stay secure. 11.